On the morning of September 15, 2008, employees began arriving at the Lehman Brothers headquarters at 745 7th Avenue in Manhattan and found their colleagues already sitting outside on the steps on the sidewalk in suits, holding cardboard boxes. Some of them thought it was a fire drill. It was not. At 1:45 in the morning, while most of America was asleep, the largest bankruptcy filing in United States history had been submitted to a federal courthouse in Lower Manhattan. $613 billion in debt. Signed, sealed, done. This is how a 158-year-old firm destroyed itself in a weekend. And why every single person who was paid to stop it let it happen anyway. Before we get into what Lehman did, you need to understand one word: leverage. Here is what leverage means. Imagine you want to buy a $10 toy, but you only have $1, so you borrow $9 from a friend. You now have the toy, but you owe 9 times more than you actually had. That is leverage. You are playing with someone else's money, which is fine as long as the toy holds its value. But what if the toy breaks? What if tomorrow it is worth 0? You still owe your friend $9. You have nothing. You are finished. Now imagine doing that, not with a $10 toy, but with hundreds of billions of dollars in mortgages. And instead of borrowing 9 times what you have, you borrow 30 times. That is what Lehman Brothers did, every single day. Lehman Brothers was founded in 1847 as a cotton trading firm in Alabama. By the 2000s, it had become the 4th largest investment bank in America. Not the biggest, not the flashiest. Just there, institutional, immovable. The kind of firm people assumed would outlive them. The man running it was Dick Fuld. He had been CEO since 1994, and his reputation on Wall Street was simple. You did not disagree with Dick Fuld. His nickname was the Gorilla. A former colleague once described a meeting with him as trying to tell someone their house is on fire, while they stand in the flames, insisting it smells like a barbecue. In the summer of 2008, with Lehman's stock already down 73%, and analysts writing its obituary, Fuld stood in front of his senior staff and told them the firm was, quote, in great shape. He was not lying to them. He genuinely believed it. By that point, the two were impossible to tell apart. A few years earlier, in the early 2000s, Fuld had spotted the opportunity that would eventually kill the firm. America was in a housing boom. Banks were handing out mortgages to basically anyone who asked. Lehman started buying up those mortgages, hundreds of billions of dollars worth, and packaging them together like a financial smoothie. They mixed them all up and sold pieces to investors all over the world. The smoothie had a name. It was called a CDO, and everyone said it was delicious. Now here is where it gets interesting. The CDOs, those mortgage smoothies, needed a grade, like a school report card, but for financial products. The highest grade you can get is AAA. That means safest possible investment. Basically, impossible to lose money on. Lehman's CDOs were getting AAA ratings, thousands of them. But here is the thing. The companies giving out those AAA ratings, they were being paid by Lehman. Lehman hired them, paid them, and said, please grade our product. And the rating companies said sure. That is like hiring your own teacher, paying them, and asking them to grade your homework. You are not going to get a D. The mortgages inside these CDOs were genuinely terrible. People with no jobs, no savings, no ability to repay. They had gotten mortgages anyway. And those mortgages were now inside packages, rated AAA, at its peak. Lehman was sitting on $85 billion in commercial real estate alone. Their leverage was so extreme that a fall of just 3% in asset value would have wiped out every dollar of real capital the firm had. Not 30%. The housing market did not fall 3%. It fell 30%. Lehman knew the risks were growing. They bought more anyway, because every time they did, they made more money today. And Dick Fuld believed the whole thing would never stop going up. In 2007, the housing market started to crack. People who could not afford their mortgages started missing payments. The cracked houses inside those AAA boxes started to show. Lehman's stock began to fall. Then it collapsed. In September 2008, the U.S. government made a decision. Bear Stearns, another bank drowning in the same debt, had been bailed out 6 months earlier. Every bank CEO in America assumed Lehman would get the same treatment. By Sunday night, the negotiations had failed. Lehman Brothers had run out of time. They let it fail, no bailout, no last-minute deal. Treasury Secretary Hank Paulson looked Dick Fuld in the eye and said no. The official reason? We cannot keep bailing out banks. The unofficial reason is still debated. What happened next was not what anyone expected. The entire global financial system started seizing up, like a car engine that just ran out of oil. Banks stopped lending to each other. Credit froze. Stock markets crashed worldwide. The government panicked and bailed out everyone else. AIG, Citigroup, Bank of America. Within weeks, Dick Fuld, the man who drove the company into the ground, had already made approximately $500 million in compensation over the previous 8 years. The average Lehman employee lost their pension. Every time this story gets told, the conclusion is the same. Greed. Wall Street was just too greedy. But greed has always been there. Greed did not invent itself in 2005. Greed is not the variable that changed. Here is what changed. The people rating the risk, those companies giving out AAA grades, were being paid by the people selling the risk. The people selling the risk were being paid bonuses based on how much they sold, not on whether it worked out. The regulators watching the whole thing were operating on rules written before these products even existed. Nobody in that entire chain was personally paid to ask, what happens if this is all wrong? If you remember our WeWork episode, this is the exact same architecture, different product, same incentive design, same silence from the people paid to speak. This is not a Lehman story. This is the story of what happens when the people responsible for watching get paid to look away. And it is still the story being written today. Every corporate collapse leaves behind a paper trail. Most people never read it. Subscribe to Corporate Autopsy. The next case file drops soon.